Y'all, today we are talking about rate buydowns, and I am happy to have Kelly Decker, who is a top producing sales manager at First United Bank. And Kelly ranks among the top 1% of mortgage originators. So we have invited Kelly to jump in on rate buydowns so that we can better utilize this for our buyers and our sellers and really jump in and hopefully save a deal if we need to. Thanks for joining us, Kelly.
Yeah, thank you, Robbie. I really appreciate the opportunity. I'm honored and always enjoy connecting. So thank you.
We love having you. Tell us, what is a rate buy down and really kind of how does it work?
In the simplest terms, what the rate buy down is. It's a way to temporarily reduce the monthly payment that a buyer is responsible for in the first few years of their mortgage, utilizing a subsidy typically funded by either a seller or builder.
Okay.
Um, so that's in its simplest terms is what it is, but it is right now, I think one of the best tools out there to help overcome a lot of buyer reluctance when it comes to, look, I just don't feel comfortable with that payment. Okay, well, we
Right.
have a solution. We have a solution to be able to reduce that payment, at least temporarily.
Hmm.
And I think that it's gaining a lot more popularity. I'm getting asked a lot more about it. But as maybe homes are sitting just a little bit longer, it's a great tool on the listing side as well.
Right. Are there any type of loans that you can't do a rate buy down on, or are they just pretty much open across the board?
There are some limitations. You're typically you can do them on pretty much any of the conventional FHA, VA type financing, but it's really the occupancy that's where the limitations come into play. You're normally looking at a primary residence or secondary home. You're really
Okay.
not able to do this on an investment property.
Okay.
So that's really kind of where the focus is.
Is it something that only a seller or a builder can pay? What if they're negotiating a transaction and the seller's not interested and the buyer's really unhappy with that rate? Is that something that they can do?
They can. It's not as common. Fannie Mae, Freddie Mac allow that. They in essence they would allow any interested party to the transaction to contribute towards the temporary buy down. So a seller, realtor, lender, or buyer. But you normally are seeing it's a situation where it's either the buyer or excuse me, the seller or a builder is the one that is contributing.
Right.
Think maybe what I could do is run through just a quick example to show
I love
um,
it.
kind of what the benefit is and kind of what this cost is that we're looking at and how significant that benefit would be. So the most common one that you're hearing today is referred to as a 2-1 buy down. And
Yes,
so
sir.
in essence, what your two and the one stand for is the buyer is paying a monthly payment based upon 2% below their note rate. So in the scenario that we're operating with, let's say if the market rate is 7.25%, in year one of their mortgage, they're going to be paying a monthly payment calculated based upon 5.25. So
Okay.
that's the two and the 2-1. And then in year two, that monthly payment is calculated based upon 1% below
Okay.
the note rate. So in year two, we're at 6.25. In year three, we're returning back to the note rate at 7.25. So in this scenario, what I'm looking at is a $500,000 purchase, someone putting in 20% down payment, so financing $400,000. So if
Okay.
we look at in how that subsidy is calculated, we look and see, okay, in year one, what's that subsidy going to be? In year two, what's that subsidy going to be? So over the 2 years, that calculation comes to approximately $9,500. That's how much the buy down cost would be.
Okay.
So we then look at what's the monthly savings for the buyers. In year one, the principal and interest, they're saving $519 a month on $400,000 loan.
Okay.
That's fairly significant when you're looking at, from a budgetary standpoint. In year two, their monthly savings is $265 a month, And then in year 3, we're back to the normal principal and interest payment. But that $9,500, again, that cost of that buy down is oftentimes borne by the seller, whether it's the builder or a private seller. If the home appraises high enough, we can bump that $9,500 into the purchase price.
Okay.
So that's sometimes how we're able to accomplish it, where maybe the seller is somewhat reluctant, it's upfront. We then go back and restructure things once the appraisal comes in.
What rate actually is a buyer having to get approved on? Is it, for example, the 5 or would it be the 7?
That's a great question. They still have to get approved at the 7.25% interest rate. That's where their approval stands. And so I think that that's kind of where um, we as mortgage professionals, we have to take the time to ensure that we're educating those buyers, that they're just not totally fixated on what's my monthly payment. Well,
Mhm.
your monthly payment right now is this, but it will go to this.
Okay.
Right. So you've got to make sure that they can qualify and that they can carry that monthly payment at that higher interest rate.
Let's say they decide to refinance or sell before the buy down kind of ends. Are there any prepayment penalties that they'd have to do, or is that just would be money lost?
That's a great question. I think that that's one of the most beneficial aspects of this temporary buy down is what happens if they end up paying off early. So
Okay.
there is no prepayment penalty. But let's say at the end of year 1 of this scenario that we're working with, that they had $9,500 in their account in this temporary buy down account, and they used $6,000 of the 9,500. Well, so now they've got $3,500 left in this account. They decide to refinance. That $3,500 is applied towards their principal payoff on their refinance. They don't lose it.
Okay, so it sounds like the money is actually held in maybe a lender escrow account that would be
It is.
separate from what they are actually using to pay their, taxes and insurance.
That's exactly correct. It's signified as a special escrow account. It's held with the lender. So the lender is taking their normal monthly payment and then taking that subsidized amount out of this additional account and keeping track of that. So that again, when the time comes, if there are excess funds, it's they're not lost. They can be applied. So if you compare that to say like a permanent buy down where someone's just going to come in and pay points, that's a
Right.
sunk cost. That they're never getting any of those funds back. They're making a bet that interest rates will stay where they're at or go higher, and that they're going to keep that mortgage for X number of years to be able to realize a return on those funds. They're buying down that interest rate. And in this case, it's actually in many cases they're betting the other way. Is that they're betting that interest rates are actually going to drop in the next couple of years, so that they will be in a position to refinance, taking advantage of lower rates and be able to maybe have some funds left over in their temporary buy down account to apply toward principal. In the meantime, they're able to get into the house that they want at a
Mhm.
payment they feel comfortable with
Right.
on a monthly basis. And so that's really that where we're helping to get over that reluctance that someone that has right now is, interest rates are so high, I just don't feel comfortable with that payment. Well, here's how we can overcome that objection.
I just had a transaction that we just closed on. And during the option period, the buyer's agent sent over a termination because they did not like the payment. And she was very frustrated and upset because she'd been showing them for an extended period of time. And then they get their payment and they're not liking it. And she's not even trying to save the deal. So I immediately pick up the phone and start trying to talk to her and find out what the situation is.
Mhm.
And a long story short, I literally asked her, had they thought about a rate buy down? And she did that typical response that some agents do that that's the mortgage part. That's not my job.
Right.
And I said, well, you ought to, at least talk to them about it. And she immediately asked, are your sellers willing to pay for a buy down? And I said, I actually don't know. You've not presented us with anything. And it took about 5 days for them to finally get everything together,
Mhm.
and it was a significant savings. Is there a way, or is it kinda difficult to kind of figure these out on our own, or is it gonna be specific to the originator and the lender where it's gonna be financed through?
Yeah, I would say that, if you know how much the client is financing
Mhm.
and you know what interest rate they're paying, then you can figure it out. There should be some calculators online. You can definitely contact me. I'm happy to run those numbers for you as well. But it's oftentimes working directly with a loan originator that does know and is familiar with temporary buy downs that can work those numbers up. Uh, Again, it's not anything new in the business. It's simply a tool that hasn't been used. Well, there hasn't been a need for it. And
Right,
so the need is there now. And so some people maybe that haven't been in the industry quite as long, um, maybe just aren't aware of the tool. But I think it also just goes back to that communication aspect of are you as a loan professional making sure that you're educating and communicating with not only your clients but your referral partners and ensuring that all the information is being shared and education is in place to make informed decisions, so that you're
right.
not spinning wheels like what you ran into, Robbie.
Yeah, it was very frustrating because I thought they would have already seen the payment well before they even, you know, put in an offer. I thought their loan originator would have done that, and they didn't. And I think it was symptomatic and showed really they probably needed somebody different because it took 5 days to kind of work through that. And, it was, of course, better for my seller to, hold on to the deal instead of losing it.
Right.
And, are you finding that more buyer's agents are trying to find out about this or talking to their clients about it? Or is it mainly maybe listing agents who are reaching out and finding information to include in their marketing for their properties?
So, yeah, that's a good question, Robbie. I'm finding that right now more on the sales side. It's listing agents who are seeing, you know what, maybe the market is slowing just slightly. And what unique ways can we position our listing to stand out from another? So, yeah, I see a lot more on the listing side, mentioning that, offering that in their MLS. But again, a lot of that's great that it's out there, but it's really up to the buyer's agent and more importantly, the loan officer to do the education with the buyer to understand what does this mean? Yeah, the seller's willing to give me $9,500 in concessions, but how do I use that? What does that even mean? And so that's where this education piece of it really comes.
When you have, let's say, a conventional financing and it may be they're putting 10% down, so they're limited to 3%. If they're getting money from other places, does that affect the money that they can get from a seller that would be willing to do a buy down? Maybe they're
Correct.
getting money from
That
for closing costs?
Yeah, so there are limitations, as you mentioned there, and so what you're looking at is that temporary buy down does go towards the total limitations. Now,
Okay.
that limitation cost is based upon the sales price of the home, right? So what we're looking at is, and like if you're doing 10% down, it's 3%. If you're doing 10 to 25% down, you're up to 6%, and then greater than 25% down, it's capped at 9%. Very rarely are we getting anywhere close to those caps.
Okay.
Sometimes, if we're getting in that 10% down or less, maybe. And then again, that's kind of where we have to just sit down and put together a strategy of are we utilizing the funds properly? So it may just be a way of, okay, well, we need to reduce this contribution and move it over to this bucket. And that
Right.
way we can make it all work. But yes, there are some limitations, but rarely are we running up against those limitations.
What about potential risks or downsides for a rate buy down for a buyer? Are there really any?
I think that it goes back to a buyer getting comfortable with a monthly payment that's much lower than what their note rate is, and then all of a sudden here comes the note rate, and
Right.
they've budgeted, they've planned, they've set up their financial lifestyle based on the lower payment, and it's no longer that the payment that they're making. So I think that's the risk is, and that again, I think it comes back to the education component where we as lenders have to ensure that everyone that's involved knows that this is not going to be in place for the full life of the loan. That our goal would be to refinance when rates drop, but worst case scenario, rates don't drop. It's not as if they're on an adjustable rate. We know worst case scenario what their payment's going to be.
Right.
We're making sure that they see that, understand that. Do you know this? Do you feel comfortable with this? Okay. So that's the baseline. Now let's see if we can improve upon it. And that's kind of where we go. But I think that's the risk component that buyers would run into. I see it as kind of one of the few true win-wins between a seller and buyer, where the seller is able to come in and offer a a modest incentive that creates a significant benefit for the buyer and
Right.
creating a win-win on both sides.
Yeah, it definitely saved the deal we were doing and enabled them to continue, purchasing it, and I was kind of frustrated that the buyer's agent didn't take the initiative and, investigate that for themselves, and, I got that typical not doing the mortgage person's job.
Right, right.
So, I was like, "Yeah, but your job is to, you know, represent your client at the highest level. And part of your fiduciary duty as a real estate agent is to kind of oversee everything."
Yeah.
And I think people forget about that.
I think it's a matter of too, just having, why it's often very important to have a great relationship between as a buyer's agent, having your preferred lenders that you know that you're referring out true professionals that are going to be bringing these solutions proactively to the table.
Yeah,
That these are partners, not transactional um, widgets that are, you're just going to replace it each time. That these are true professionals that are coming to the table and are part of your toolbox of success to get a deal and the client the best thing possible.
absolutely. Across the board from lender to lender, do they figure the cost of a rate buy down the same, or do different lenders use different factors on the actual cost?
Yeah, it should be the same. The math should be the same regardless. Um, on that buy down component of it. Again, it's just making sure that you have the inputs correctly around how much is being financed and what's the interest rate along with the term. So yeah, it should be the same regardless of the lender that you talk to.
What about jumbos? Can you do them on jumbos?
That's Jumbo's being portfolio type loans. It's going to be on a case by case basis. Right now, we're not operating the temporary buy down on the Jumbo
Okay.
portfolio program that we're offering. We do have it on pretty much every other program. But yeah, right now we're not offering that. That would probably be on a case by case basis with each portfolio lender because guidelines for the portfolios are really nuanced amongst the lenders.
So basically just a regular or conventional, VA, FHA style of a loan.
Yeah, exactly. That's kind of where we're seeing them be the have the biggest bang for the buck right now.
Is there any type of disclosure that a realtor would need to make on a buy down that they would need to be extra careful? I know mortgage, y'all have tons of disclosures that you have to put and extra little wording and, based upon this. Is there anything that we need to be or just say, offering a 2-1 buy down and, check with the agent for more details or?
Yeah, in terms of writing something like that into like a listing or something of that nature. Uh, yeah, I would probably word it open-ended, that you have an incentive, or a credit towards closing of X, which can be used towards a temporary buy down. We have, as you mentioned, we have a tremendous amount of disclosure that we have to do on our side. In
Right.
the contract, it's just references a typical concession from the seller. As you guys are writing the contract, there's no need to designate that it has to go towards a 2-1 buy down or any type of temporary buy down. It's just credit toward closing costs. We really take care of the disclosure side of that once we get it into our system and educating the buyer on it.
Yeah, in the contract in Texas, the one before it's 12A1B that
Mhm.
they could do, or in the amendment, it is item number 4 that they could add it. But be careful, always check when you're filling out that amendment to make sure that you check 12A1B in the contract so you're not losing any money as you're putting stuff on the amendment. Any other words of wisdom for, a listing agent out there? Is the 2-1 the most popular? Are there any others that are out there?
There are 2-1 is the most popular.
Okay.
There is a 3-2-1 as well,
A
where
lot
the
more
interest
expensive?
rates, yeah, it's significantly more expensive. So we're not seeing that utilized nearly as much. There is a 1-1 buy down where the rate, your monthly payments based upon 1% below for 2 years. And then there's a 1-0 buy down where it's just down 1 year from the note rate, and then in year 2, it returns back to the note rate. So there are some variations of it. Again, consulting with your, loan professional. I work, help out a lot of my agents that have listings and, I'm not involved in the transaction, but I'm helping provide information and guidance on how to structure that. But in my mind right now, you you can get more out of that specific to a buyer wanting to pull the trigger and move forward versus reducing that price by $10,000.
Okay.
Everyone else being whole and the same amount of money changing hands, you can get more out of it by doing this temporary buy down versus a reduction in price and just making sure communicating that on the listing side of things.
Right.
Um, yeah, how I would approach it.
That's huge because I think a lot of agents just immediately think price and their pricing strategy, and they're doing price reductions, and they're not looking for other creative methods that could definitely help a buyer with that transaction. Because even if you drop that sales price by $10,000, let's say, then it doesn't really help them with their payment because $10,000 isn't going to reduce it that much where the rate buy down really would.
Mhm. Yeah, exactly. Um, it's insignificant that $10,000 reduction in price, what they're going to get on a monthly basis. And right now, because interest rates are where they are, payment is a predominant deciding factor for buyers. And that's
Yeah.
really kind of where we've got to focus our efforts on how can we help with this payment. This is an effective way to do it. And you see a lot of new construction, a lot of builders, the big builders, they are they are utilizing this tactic across the board. You
Right.
see this is the type of incentive that's being offered by the big builders. So that's kind of how, again, they're using it. How can we mirror that, take advantage of ways to replicate that and maybe in the resale side of things and compete on an equal ground.
Yeah. That really does help. Thank you, Kelly. I appreciate you taking the time. I know you're busy and got a whole team of mortgage professionals there working with clients, trying to get everything done. If folks wanted to reach out to you, what is the best way that they could get a hold?
I would say a couple of different ways. So my email address is the letter K Decker DECKER at First United Bank, and First is spelled out. You can also reach me on my mobile anytime. It's 214-908-6792. I work when you work. So I understand this is not a 9 to 5 job. It is clients need us. We are available. So text, email, call, whatever you might need when you need it. We lend all over the state of Texas. Actually, we lend all over the country for that matter. So if you have a client moving out of state, oftentimes we can help with those relocations as well.
We'll love that. Thank you again. And if you did not catch his email address or phone number, we are going to put it in the show notes below. So you will be able to reach out to Kelly and learn more about the services and types of loans that he handles so that he can help your clients succeed in that real estate transaction. Thanks again, Kelly.
Yeah, thank you, Robbie. I appreciate the opportunity.
Absolutely. Thank you for tuning in. We're dropping new episodes every Sunday at noon Central Standard Time. We'd love your support for The Real Tea with Robbie English. By giving this video a thumbs up and subscribing to the channel, it would really help us out. Be sure and share it with your colleagues and friends, and until next time, we hope you have a profitable and productive week.